We're moving right along, though. So that was an awesome presentation from Trevor. We have one of the newer companies. We did have Flora Growth on earlier, and I think they're the newest. However, Lynn Tannenbaum is here with me now. Welcome, Lynn, to talk about one of the newer entrants to the NASDAQ cannabis space. With that, how are you, sir?
All good. How are you?
I'm doing well. You've been a great friend and loyal attendee to Benzinga conferences. It's always good to have you up here with us. With that, sir, I'm just going to let you take it away and tell us what AFC is up to.
Awesome. Well, thank you. Good morning. Advanced Flower Capital is a nationally recognized lender, strategically positioned at the center of the cannabis ecosystem. Since gaining our public listing this year, symbol AFCG, we're the leading lender in the cannabis industry and the only legally listed lender on NASDAQ with 13 active loans across 14 states and regulatory approval, which is not so easy to get, in a number of key states. Next page, let's go. So we have a great team, and the team really is with our three partners, myself, John Calico, who I knew in high school and college, who is a fourth generation real estate family and manages several $billion of real estate loans, and Robin Tannenbaum, my excellent partner and wife, who runs Origination. So when you think about the market itself, and I know you've seen this throughout the Benzinga conference, it's really amazing how fast it's growing. But this doesn't even include, it will include, but doesn't even include the great states of New York, which we'll get into, and other states which are coming online. And I actually think that the growth is really understated. I think it's going to be even better than this. And where has the market share been, right? It's been in states like California, Oregon, Washington, and then started leaking into what we call the limited license states. We do not currently lend to California, Oregon, Washington, and Colorado. Not that I don't mind Colorado. Colorado's okay. But those are unlimited licenses and a very deep black market, actually. And so what we really focus on are those states with limited licenses that we can quantify the supply and demand equation. We can give value to the licenses themselves and secure by them. And we'd spend a lot of time understanding how each state is moving. And we're going to go into that a little bit later, giving you some insight to some of our state-by-state research, which we really dive into seriously. And on the next slide, there is. So two of the states we do lend to, Ohio and New Jersey. We can talk a little about them. So Ohio is interesting. I think Ohio ultimately goes rec. Ohio has a little over 60 dispensaries. You can't own more than 5. So it's a true limited license state. And there's 2 different types of cultivation licenses, a C1 license and a C2 license. So a C1 license, the big one, obviously, C1 is greater than 2, and C2 license being the smaller one. In a state that's starving for flower, you're talking about average wholesale flower probably around $3,200, which is great. So this state, we were invested both in the dispensary side with one company, cultivation side with another company, but the state's constantly changing, and just additionally added 71 licenses. So we're going to talk a little bit about how that dynamic changes, and how that regulatory changes. So maybe it's better to be in cultivation right now, a little bit less in dispensaries. There's more competition's coming, but it doesn't really matter because in Ohio, cannabis continues to be growing rapidly, and recreational will take that much bigger. Now, New Jersey, of course, just goes rec. We think it's $1 billion build out in New Jersey, and we were pleased to announce a $22 million loan to a New Jersey company to build that out, supported by a really great company. Now, to lend in New Jersey wasn't so easy. To lend in New Jersey, we literally had to go through the entire licensing process. Think about it almost like a casino license. So in order to lend, you have to go through the licensing process yourself as a lender, and then get certified by the state to be a lender in that state. So Ohio Board of Pharmacy was one, New Jersey was another. These are some of the real barriers to entry for other people trying to make loans in these states. Now, Michigan and New York, the reason these are on the chart is because I believe New York has an almost unlimited license state, but with limitations to the real estate and locale approving that cultivation facility or approving that dispensary, is going to be a lot like the curve we saw in Michigan. And Michigan's a great state. We do lend to Michigan. It is unlimited licenses. In other words, you could stack up the cultivation licenses to make a bigger cultivation, but the growth has been really great. And as it went rec, I mean, the demand has been also very strong. New York is just beginning. As soon as they get the regulatory environment set, as soon as they issue their licenses, we think it's a $5 billion build out over a couple of years. So we're going to see a massive demand of capital. When I talk about AFCG's actionable pipeline and how big that is, it right now doesn't include New York, but we expect New York to be a big piece of that business. So what's going on with the federal overlay? I mean, this is probably the number one question asked by our shareholders and potential shareholders of our public company. And look, we do see Safe Banking Act passing in the next year or two, probably next year, since Schumer decided to take federal legalization first, and we think that fails. I'm not quite sure why Schumer's doing that, because what's very important to all of these states, especially his state of New York, is taxes, right? This is why the states really want to keep it to themselves. They want their own regulatory authorities. They want their own testing. They want their own cultivation, and they want their own sales. But safe banking is really great for our customers because we need more places to deposit. We need more places to pick up cash. We need more places to stop charging ridiculous fees for debit cards. And really, Visa and MasterCard's not available. And so I hope Safe Banking Act passes. I think states will ultimately pass more in a 3 to 5 year time frame as the regulatory unfolds. And so we really have that timeline to help these companies grow and position for this rapidly growing industry. So what is our market opportunity, and what does it create? As you well know, right? It's very difficult to invest in cannabis, but getting easier and easier as more and more companies can do it and are comfortable with it. Part of that was the Biden administration, the Attorney General signing a piece of paper saying that the federal government will respect states' rights. So that limited supply of capital, there is more capital coming in, which is really great for the cannabis operators, but it's not anywhere close to the amount of capital necessary. Up until we came along, there were some loans, but IIPR and others dominated sale-leaseback. So sale-leaseback was the top form of financing. And now it's going to continue to be some sale-leasebacks, but it's also going to be loans. And you'll probably hear about that later on our Benzinga panel. We have 2 sale-leaseback firms and 2 loan originators, and we're going to talk a little bit about the differences. But what are the market challenges? The state-by-state regulations, a very complicated market to really understand the changes in supply and demand dynamics in the state, who's going to win, who's not going to win. Ultimately, the smaller companies are going to be at a disadvantage because of cost of goods sold and because of scale itself. So you really have to understand vertical operators versus non-vertical operators. I know I'm going into the details, but this is a cannabis conference, so I'm going quickly. And what we want to do as AFC is provide those opportunistic solutions. We want to think about what is the indifference curve to our customer base and how do we satisfy them? Do they need more equity? Do they need more, revolver capital? Do they need build-out help? We've built a lot of that. We've helped finance a lot of the cultivation facilities around these states. So we know how they're built. We know how the size, we know the scale, we know the cost. We know the efficiencies, the light density, the fertigation systems, and everything. We have on-site construction managers and real estate locators that can help our customers with their builds and to say, well, maybe you need 2 dry rooms, thinking about that philosophy, not 1. So I think going into the details and helping partner with our borrowers is really essential part of AFC's business. So let's talk about what everyone wants to talk about is, how many deals do you actually look at and what happens to them, right? So we've looked at over $5 billion of deals. We've thrown out about 1/3 of those deals in California, Oregon, Washington. And so you have 2/3 left. And then you're looking for companies with strong operators in limited license states that understand their business and knows how to grow it, knows how to execute on that plan. So experience is really important. And business plan is really important, right? Are you just 1 or 2 dispensaries? We're probably not going to lend to you. We really do want that cultivation or cultivation dispensary mix. Of course, a few dispensaries in Pennsylvania, that'll be amazing. And because they're all amazing in Pennsylvania, it's pretty much hard to miss in that state. And then so you funnel all those great deals down. They go to our investment committee. We have 19 people going up to, I think, 25 by the end of the year, maybe 30. And so we're set up in origination support, investment committee, underwriting teams, portfolio monitoring, portfolio management, every team different, every team in a handoff. And so far we've invested about $200 million, and we have a full pipeline that we're converting. So who are we lending to? And what are we lending? So we lend first lien debt. I don't know why second lien debt. We haven't done any second lien debt, but we're open to it. But we're really good at construction loans. We're good at the construction financing. We give a revolver. We draw it over time. We help with that construction. We understand how the state-by-state dynamics work. We understand your phase 1, phase 2, phase 0 build-outs, and we partner with you in growing the company. And the nice thing is we don't do small loans. We're not doing loans under 10 million. We'll leave that to other people because it doesn't make sense for us. Remember, we're NASDAQ listed lender, so we have to do our anti-money laundering. We have to do background checks on principals. We have to do all of these important things when you loan money, and that costs money too. And so we help institutionalize our partners, and we deal with everyone from the big ones, the big multi-state operators, the 1 or 2 state vertical operators, or the ones with a track record that are building in a new state that's a limited license state, and that we can get behind that management team. So why us? We're a leading lender. We partner with our customers. We leverage our relationships. We have a repeatable institutional process. It's not just about lending money. It's about helping build businesses. We love the industry, and we love participating in that ecosystem. As I said, I built my other company, which is a $5 billion lender in the middle market. And we're using all of that knowledge base when I built the first company, where we did almost $1 billion a year in the middle market in cannabis, where we're really providing that institutional approach. And for that, that's my presentation.
Thank you so much, Len. A lot of information about the markets in general that you lend to in there. So I learned a lot, I'm not going to lie. I have some questions for you. I think we have one in the chat here from Jim. But what is your thought on M&A in the industry? How do you view what's going on in consolidation right now?
Well, I think we're in an M&A cycle here. I think it's going to be 2 years. You're seeing everything being bought every month. A bit different MSO buys something in the state where they're filling in their overall infrastructure. And you saw a lot bought in Pennsylvania. You're seeing flurries of activity in different states too, right? You saw Florida, a number of purchases, Pennsylvania, a number of purchases, all in a flurry. And so I think that will continue. But there will be 15 top MSOs because a lot of the states have structural parts to it, like Ohio that we talked about, where no one can own over 5 dispensaries, right? That allows for multiple competitors. And many states do want that competition. And so I really do think there's going to be 15 big ones. And then the small ones either are going to have to try to be one of the big ones or sell to one of them.
Well, we'll see who those big ones are once it all settles down. But I guess in parallel discussion to those potential 15 large MSOs, where does AFCG end up in 5 years' time?
Well, 5 years in cannabis is like 35 years. So I think every year in cannabis is like a dog year. So I have my 2 and 3 year view, and what we look forward to is loaning money to half of the top MSOs, $100 to $200 million checks, and capturing the arbitrage. Like, unfortunately for them, they're listed in Canada, and so their cost of capital is somewhere between 11 and 13%. For them, and our cost of capital should be around 6 or 7%, given our debt cost of capital. So if I can give them $200 million, borrow in the U.S. at 6, 7%, and lend them and capture that spread, drop it down to my shareholders, I think that's a really good business model. At the same time, over the next 2 years, you'll see us continue to invest in where I think there are targets. So we talk to, the heads of acquisitions at many of the top MSOs in terms of what they want to buy, and they often want to buy our customers. And the reason they want to buy our customers is because after we diligence them, do quality of earnings, and help them professionalize their infrastructure, they make very easy acquisition targets. And so that's really great for, Verano, Cresco, TerraSend as they go hunting. If they know AFC is a lender, they know the company's clean, they know the company has some infrastructure to deal with an institutional borrower, and they can jump in there and pay the price that they want to pay.
I really like that, Lynn. That's a super interesting point. And it sounds to me like with that 6-7%, you are looking ahead to a federal legalization model. Those rates aren't just absurd. Talk about a risk. What does AFC? I guess what do you worry about? What's a risk to your business?
So actually, the 6-7% I think is my cost of capital today. I think it goes down to 4% with a legalization model. But
Nice.
remember, we're legal. We're Nasdaq listed. You can buy our stock, and Nasdaq wouldn't have listed us had we not done it legally. So if you're thinking about that, whether I did a baby bond offering or I did a 144A debt offering, the first one in the space was just done by IPR. And they raised $300 million of unsecured 5-year money at 5.5%, and that's trading at 4.8%. So look, they're much larger than us. They probably will have a slightly higher credit rating than us, but that's an idea of a cost of capital that we can, think about achieving. As for what was your other question?
The risk to your business.
The risk.
No, yeah.
The biggest risk is easy. It's states changing their mind, right? When Illinois, we're not big in Illinois, but Illinois decides, another 110 dispensaries to social equity, or somebody changes in Florida, we're going to see looks like we're going to see 15 more cultivation licenses. So a cultivation license in Florida, which is an amazing license in a terrific state, we do live here, 550,000 medical patients, could have traded for $40 million recently. My guess is that's going to drop back to the $25-30 million range, because now you're getting 15 more potential competitors. Now, yeah, they won't get online till 2023, but they'll come, and in one of the best states in the country. So those changes, like nobody knows how many licenses, whether a state's going to, like Texas is going to increase the THC content. Looks like they're stuck at 1% from 0.5%, which makes no sense. But it could have been that Texas was about to open. Now it looks like it's not, but you just never know. And so that's the biggest, not risk to the business, but something we have to keep on top of, is those state-by-state regulatory dynamics.
Fantastic, Lynn. Really interesting presentation. You are obviously, and it seems like, there's obviously the IIPRs of the space, but not a whole lot of companies doing it as successfully as you. I love the story. I love what you all are offering. Again, the NASDAQ AFCG. Lynn, would you like to leave our audience with any final thoughts here?
No, but please you listen, and I hope you continue listening, watching our quarterly earnings reports, and listening to our story. But thank you for having us on Benzinga.
Of course, Lynn. Thanks again for being here, my friend. We'll see you soon. All right. Awesome. So that was AFC Gamma, Advanced Flower Capital. They are newer to the NASDAQ.